As we head into 2024, there seem to be three key things on the minds of investors. 1, the state of the U.S. economy and what's ahead. 2, what the start of rate cuts could mean for the market. And 3, the potential market impact of the presidential election. Despite widespread forecasts for a 2023 recession, the U.S. economy remains surprisingly resilient. Economic growth in 2023 was powered by strong gains in spending. Economic growth in 2024 is expected to slow, but to remain positive. Inflation continued its orderly decline throughout 2023, while high interest rates proved to be no match for American consumers, who powered economic growth through robust spending. Consumer confidence has rebounded, and household debt servicing ratios remain below pre-pandemic levels. However, pockets of stress can be seen in signals like rising credit card delinquencies. The unemployment rate remains historically low, but the job market is showing signs of moderate cooling. Despite moderate cooling in some of these areas, there are signs that economic resiliency could continue in the near term. Thanks in large part to the declining inflation that we saw throughout 2023, the FOMC, or the Federal Open Market Committee, has indicated that a pivot in their policy could be on the horizon. What this change in policy could mean for equity markets is likely to come down to the state of the U.S. economy. History shows that on average, returns in the 12 months following the first rate cut are positive, but roughly half that of the long-term average of stocks. However, there is a big difference in returns during times where the economy avoided a recession throughout these 12 months versus those when a recession occurred. While the economy remains strong, only time will tell if the Fed can truly pull off the soft landing that they've been aiming for. The first 5 months of election years have historically had lower average returns and higher volatility. However, regardless of the outcome, markets have tended to bounce back and return to an upward trajectory following both the primaries and election days. This is in part due to the market's dislike of uncertainty. Despite the short-term volatility election years often bring for long-term investors, the political party that wins the White House has had little impact on returns. Since 1936, the 10-year annualized return of an investment in U.S. stocks, as measured by the S&P 500 index, made at the start of an election year was strong, regardless of whether a Democrat or Republican won the election. I realize that I just covered a lot of information, and if I were to sum it up with 3 key points, I would say that 1, the U.S. economy has continued to prove itself more resilient than initially thought. This is due in part to a strong U.S. consumer and a strong U.S. labor market. 2, the Fed has made progress towards its goal of bringing inflation down to 2%. If the same trajectory continues, it is possible that we will start to see rate cuts this year. And 3, since the market has historically performed well under both parties, the best approach for many is to tune out the political noise and to stay focused on the long term. As always, if you have any questions regarding the things that I talked about today or anything else, please feel free to reach out to us. Thanks for watching.